Hi everyone, Mark here at Fortune Financial, and today I'm here to talk to you about life insurance. What does it mean? What are the types of life insurance, and how is the best way to set that up for you? Now, firstly, you're on the YouTube channel. If you do like our videos and you like this video, drop us a like, please. Drop us any comments. We'd love your feedback. And important, you subscribe, click the subscribe button because it'll enable you to watch our videos in the future and be given notifications to allow you to see when new videos have been uploaded for you. So let's get on to it. Life insurance, what does it mean? What types are there? And is it right for you? So when it comes to life insurance, there's a number of reasons you arrange life insurance. Let's start with family protection. Family protection can also be called personal protection, and it tends to be set up on the basis of over a term, maybe up until retirement, likely up until retirement, because when you get to retirement, it seems that you are financially stable. Now, there's other forms of life insurance as well, such as mortgage protection. Now, mortgage protection would unlikely be set up until your retirement age. It will be tailored over the term of the mortgage instead. So let's jump back to family and personal protection. Regardless of whether you're an individual who has a partner, or alternatively, an individual who has a partner and children, life insurance is going to be important for you to ensure that you give peace of mind to your partner or to your family. Now, family protection and personal protection can be set up by means of a lump sum amount that pays out if you pass away within the term of the policy. Now, regards to that lump sum, it tends to be tailored based on remuneration. So based on your income and a multiple of your income to replace that, because God forbid, if you did pass away, of course, your income would stop and stop providing a financial stability and lifestyle for your family. So when it comes to family and personal protection, it can also be called term assurance because it's set up over the term of the policy. And if you die within the next 5, 10, 15, 20 years, up until your retirement age, may that be 65, 68, wherever you feel that may be, then the policy will give you that security up until that age. Now, a question I get asked a lot is, do these policies have a cash value? Or what happens at the end of the term when the policy hasn't paid out? The answer is that they don't have a cash value. And of course, the good news is that you're still alive. So the policies are here to give you financial security within the period where you would be receiving an income. And of course, you're no longer here to provide that income to your family or to your partner to be able to move forward with the lifestyle they would have wanted. Now, an alternative life insurance policy would be mortgage protection. Now, this does exactly what it says on the tin as well. Mortgage protection is there to tailored against a mortgage you would have taken out against your property as a large loan and a big financial commitment for you or for you, your partner, and your family. Now, in the event of somebody passing away, the last thing they want to be worrying about at a time where they're going to be grieving is paying off their mortgage or the ability to pay their mortgage month to month once an income has been lost because an individual is no longer here. So mortgage protection will be tailored against the balance of the outstanding debt once it's arranged and over the term of the mortgage. And this can be reviewed as time goes on, because inevitably you may change your mortgage borrowings and your mortgage term and who actually owns the mortgage itself, whether that be on a single or a joint basis. So these policies can be single or they can be joint, and they reflect the setup of the mortgage, whether that be a joint or single, or whether it would be a repayment or an interest-only mortgage. Now, that element of it is really important. If you have a repayment mortgage, your balance will be decreasing over the term of the plan or the term of the mortgage. So it's important for your life insurance, your mortgage protection, to reflect on that basis and also decrease in line with your mortgage. Now, I say in line, what happens is with a life insurance policy, it's set up to decrease at a certain interest rate. For example, 5, 6, even 7%. Now, as long as the interest rate is above the interest rate of your current mortgage, whether that's a fixed product, tracker mortgage, you will always be in credit to enable your mortgage debt to be cleared in the event of death. Now, as I say, that policy will be set up on the basis of the term of the mortgage. Whilst the mortgage is there, the protection will be required to be there to clear the debts. Now, in the event of you having an interest-only mortgage, of course, that means you're only paying the interest back to the lender month in, month out on your monthly payments. Your balance will remain the same. So you will not take a decreasing plan. You will take a level policy that ensures that the same level lump sum is paid out and clears the mortgage debt wherever that may be. God forbid if you pass away within the term of your mortgage. Now, the final policy for life insurance is called a whole of life policy. Now, this differs because it doesn't have a term. Again, it does what it says on the tin. It pays out in the event of the whole of your life when you pass away. So whether that be tomorrow, next week, next month, next year, or in many years to come, it will give you a cash lump sum through whole of life to ensure that you can meet short-term financial commitments, or alternatively, costs like funeral cover that can escalate these days, at least to the value of £5,000, if not up to £10,000. So whole of life policy doesn't have a cash value with ourselves at Fortune Financial, but it does guarantee to pay out as long as you've maintained your premiums throughout the policy up until when you pass away. Now, of course, nobody knows when they're going to pass away, but one thing we do know is that the death rate in England is 1 in 1. 100% of people will pass away. So if you take a whole of life policy, it's underwritten correctly and set up correctly for you, when you die, that cash will be passed to your beneficiaries to ensure that the funds are there to be used for whatever purpose you wish. So when it comes to arranging life insurance, it's important to talk about the costs. You'll pay for the policy on a monthly basis, and there's two types of premiums you can use. You can use guaranteed premiums or reviewable premiums. Now, guaranteed premiums mean once underwritten and once you commence paying them premiums, it's likely that they will remain the same throughout the term of the plan. For me, these are the best style of policies and premiums because you know what you're going to be paying today and long term without the ability of the premiums to keep increasing over time. With a reviewable premium, they do exactly that. They're going to increase. Very unlikely they will decrease. It's all based on claim stats on the basis of a provider choosing that they want to increase their rates. And of course, it gives you less security on your outgoings and your contribution towards your budget for life insurance. So with life insurance, there is an added feature with many providers called terminal illness cover. Sadly, many people are diagnosed with a terminal illness. This, of course, means you're going to pass away, guaranteed, from the illness you're suffering from. Now, because there's, of course, a guarantee that that is going to happen, the life insurance provider enables you to claim on the policy prior to you passing away. Now, some providers do have a clause within the policies that say within the last 18 months, for example, you cannot claim on terminal illness if diagnosed within that period. This is to protect the provider because, of course, if you was to survive beyond 18 months, you would not have been able to claim from a life insurance perspective because the contract of the term of the policy would no longer be valid. So terminal illness cover is something that enables you to kind of receive the benefits, manage your money yourself up until you do pass away, ensure that you're given any gifts, cover any financial costs, and set up your funeral preferences if that's what your wishes are. Now, finally, I'm coming on to life insurance and the importance of writing your policies into trust. I'll say that again. Write a policy into trust. Are you aware of what a trust is? Well, I'm going to tell you. A trust is a process where you write your policy into a trust which ring fences the proceeds and ensures the money goes to the right people in the right time. Now, this is a cost-free service. It's something that you should do with your life insurance. And I'll tell you why for 3 reasons. It's right money, right hands, right time. When you pass away, your money and your assets and your estates are scooped up and they're put into what's called probate. Now, probate is a process where they're finding out who's legally entitled to your assets and your estates. Now, before they do that, they will firstly want to take their cut by means of inheritance tax. Now, firstly, I'm not a tax advisor, but what I can do, I can guide you that the importance of writing a policy into trust will mitigate your tax liabilities. Inheritance tax currently is 40%. So for every £100,000 worth of life cover, potentially 60,000 to go into your partner or children, and 40,000 is going to the tax man. And I'm sure you wouldn't be happy about that. So what a trust does for you, it prevents the inheritance tax liability, or shall we say mitigates. Now, when it comes to writing a trust, it is a very simple process in that you appoint trustees within the trust to manage the monies for you and carry out that claim and ensure the monies go to your beneficiaries, whether that be your children, your partner, or somebody else. Now, it's important to pick somebody to be a trustee or a number of trustees that are firstly trustworthy, but also it's an honourable role to be picked for because they're going to be carrying out your wishes. So, of course, you want to get that right. Now, of course, you can change your trustees over the term of the plan, but of course, you do have to replace a trustee with an alternative trustee if you decide to remove someone. Now, with regards to a trust, we're talking about money in the right hands. You nominate beneficiaries through your trustees to ensure that the funds go to who you would want them to go to in the most tax efficient way, mitigating inheritance tax, and also making sure that it prevents the delays within probate. So it's an immediate payout that moves around the confusion of the probate and ensures the policy pays out immediately to your beneficiaries as well. Now, there's many providers that offer life insurance. At Fortune Financial, we've got a comprehensive panel of all the top lending providers for life insurance. And also we have got specialist life insurance providers as well. The reason we have specialists is for circumstances such as people with high BMI, significant medical issues, or definitely people that have struggled to obtain cover before. So when it comes to arranging life insurance, it's something we've specialized in for many years. We'd love to help you out with that. And if that's something we can do, contact us today at fortunefinancial.co.uk and we'd love to help you out. Thank you for your time today, and we look forward to seeing you in the next video.